So average versus marginal rate. Under the new tax law, the average and marginal rates for most corporations are going to be the same because of that 21% tax rate. But if we go back to the old the 2017 tax rate schedule, that calculation is going to be quite different. So the for example here, suppose your firm earns 4 million taxable income. So what's your firm's tax liability? What's your average rate? What's your marginal rate? So and then we'll come back to this in a minute, and but we're going to work out this problem in Excel. We're going to answer those three questions, and so. Okay, so I've set up. This is a 2017 tax bracket. So this setup, I'm going to enter our $4 million. That's our income here. So if the income, that's whoops. So we have 4 million here. So if our income were greater than, say it was 200,000, we would just enter 200,000 here and we'd stop calculating at that point. So in this case, so up to 50,000 is going to be 15%. Then we can set up a formula here. So you look equals, use our parentheses. Whoops, I'll go there. So the top of the bracket minus the bottom of the bracket. So if we do this, we'll only have to do it once, and we can pull it down. So the F3 is the top of the bracket minus E3, bottom of the bracket, and then we multiply it times the marginal tax rate, 15%. That gives us $7,500 in taxes. So we highlight that box, we go over to this corner, I can drag it all the way down here, and these are the taxes. So 6,250 is the 25% of that, the 75,000 minus the 50,000. The $8,500 is the taxes on the 25,000, the 100,000 minus 75,000, or that 25,000. We multiply that by 34%, and then the tax bracket, the tax between 100,000 and 335,000 is 39%, and that is 91,650. Then it drops back down to 34% above. So we sum that and just hit the summation over here, and we get total taxes of 1,360,000. So our average is simply the 1,360,000. So we do equal, and then divide by our income, our taxable income, the $4 million. So that's 0.34 or 34%. In this case, so our average and our marginal are going to be the same. So we go back to our sheet here. So our tax liability under, so that's 1,360,000, and our average tax rate is 34%. Just so happens that our marginal tax rate is 34%. Oops. So if you're considering a project that will decrease the firm's taxable income by $1 million, what tax rate should you use in your analysis? You're going to use the marginal tax rate. So In most cases, though, this is an unusual situation where those two are equal. In most cases, they're not going to be equal, and you're going to use the marginal rate versus the average. On your personal income taxes, they don't go down like the old corporate tax rate schedule went up to 39% and back down to 34%. So next we're going to talk about net working capital. So what is net working capital? Net working capital is just current assets minus current liabilities. So net working capital usually grows with the firm. So if a firm grows, the working capital should grow along with it. See the balance sheet for our corporation here. So we're going to we're looking at current assets minus current liabilities. Actually, the calculations are actually done in the slide. So for 2018, the 707 million minus 455 million. That's 252 million of net working capital. We go to 2017, and we can see that our current assets has increased to 760,000, and so have our current liabilities have increased to 490,000. So overall, our net working capital increase to 271 million from 251 million. So we're seeing, as we would expect, a firm that is growing and so forth. So we see an increase of 19 million. So next lecture, we'll talk about cash flow to the firm.